Hello, everyone, and welcome to the series of talks, Future in Blockchain at Imperial College London, Faculty of Engineering. My name is Mimin Nguyen, doctoral fellow at the Department of Design Engineering. Today, we are hosted by Mana Lab and Near Foundation. For those of you who don't know, Mana Lab is our research group on future of work and blockchain at Dyson School of Design Engineering. Together with researchers at Imperial College and Mana Search, we will be working on developing scientific research on how the blockchain technology will affect leadership, organizations, and the future of work. Some housekeeping before I introduce our guests. Please do drop any questions you have in the YouTube chat and we'll come back to them during the Q&A session at the end of the event. So it is my great pleasure to introduce our guest of today's session. We're going to have a fireside chat with Zihao Xu, Oxford University alumna, now principal at Octopus Ventures, focusing on deals within Fintech and distributed ledger technologies. Lawrence Tilley, partner at Netzero Capital, actually Imperial College London's alumna, focusing on investments in DeFi and blockchain. And maybe before we start with the discussion, can you please get us up to speed with your most recent projects within the web3 space? Lawrence, would you mind to start?
Sure. So I suppose we've written a few tracks recently which we're quite excited about. One recently was a project, Tonic Dex, which was an order book limits decentralized exchange built on Near, our sponsors, or rather the sponsor for this, the foundation is sponsoring a series of talks. That was a really exciting project. We participated alongside Electric Capital, Jump Capital, Jane Street, a number of market makers. Another ticket we are writing imminently is one I'm really excited about, is Guardian, which is a seed recovery phrase protocol. So that aims to address the one of the largest problems in crypto towards ushering in new users is the maintenance of private keys and ensuring the secure storage and safety of these. So Guardian Network is a protocol that aims to lower the barrier to entry for adopting safe standards for new users to safely store their private keys and recover them in the event of a loss. So those are a couple of investments we've made within the last few weeks that we're pretty excited about.
And Zihao, what are your exciting?
Absolutely. So at Octopus Ventures, we have a slightly different angle, I suppose. It sounds like Lawrence is investing quite a lot in the protocol space. We come at it from the sort of equity infrastructure space, i.e., rather than investing directly in protocols and directly in DeFi projects, we spend most of our time looking at real world companies that are building infrastructure to help the crypto space. So yesterday we announced we led the $9.5 million round into a company called Merge alongside folks like Coinbase and Alameda Research and a bunch of really exceptional angels. This is a business that helps DeFi and Web3 companies access banking as a service. So what this means is if you're trying to build a product that allows people to have accounts, that allows people to convert currency, either fiat onto crypto or between crypto themselves, the infrastructure for that has historically been relatively hard. You can go to traditional providers like Rails Bank or Modular, or even some folks might even go to someone like a Barclays. But those providers are not set up to understand the risks of crypto. And as a result, their clients in the crypto space often represent too much risk and not enough sort of profit for them to spend the time to understand them properly. And they often end up being cut off by their suppliers. So Merge is looking to provide a crypto native solution to help these companies really build and grow. We also recently invested in a company called Vinta, which is in the crypto indexing space. So if any of you know how a sort of ETF works, an exchange traded fund, typically they are passive investment vehicles which are tied to an index. The most famous is probably the index of the entire FTSE 100. It's as if you're buying a basket of the entire market. Well, that index needs to be calculated by somebody and kept up to date and administered. There's a really growing ecosystem of passive investing within crypto as well. and Vinta seeks to be the leading index provider in that space as it turns into $1 billion+ market.
Right. I mean, all products sound super exciting. I mean, I can actually see, comparing to last year, like this project that you guys are being involved now, they kind of like leading more to this real use cases. So kind of leading more into like this mass adoption. So like actually thinking of the user, like the blockchain users, like what is the need here? How can we actually make our lives easier? And then possibly, hopefully the user experience will be better, both for consumers and enterprises. And I think that would kind of allow this further adoption. But just, very first question, basic one, what got you into blockchain? Why are you even looking into Web3?
So when I was finishing my undergraduate degree at University of Manchester, I was really passionate about disruptive technologies. So at the time I was looking at additive manufacturing, 3D printing, big data, and blockchain technology. It was actually whilst completing my master's at Imperial in economics and strategy that I focused in on blockchain technology. And I focused, I'd say, the final third of my master's degree really on researching the applications of blockchain technology within payments, within traditional finance, within trade finance. However, it was through that research that I came across a company, which at the time was working towards central bank digital currencies. This was back in 2016. And through the research that I'd done and the understanding I'd built up after that period, I ended up relocating as soon as I finished the master's at Imperial and moving to Barbados. And was working towards central bank digital currencies for a few years. And the journey kind of has gone from strength to strength since then. But it was initially that passion towards disruptive technologies which caught my attention. But it was the opportunities which Imperial facilitated through the masters that actually allowed me to really begin that journey.
And you see how? Was it also at uni that you discovered blockchain?
Yeah, not quite at uni. It sounds like I'm probably, crypto wasn't a thing when I was at uni, so I've probably got a few years on you, Lawrence. Although uni did spark the journey, actually. So I studied economics and relatively quickly fell into what's called the Austrian School of Economics, which is quite a specific set of beliefs and a set of assumptions and theories of how the market works. And one of those beliefs is around the idea of having a free market for money, right? So if you imagine right now we have largely a free market for laptops, for apples, for pencils, bits of paper. Lots of things in the market are freely competitive, but money was not one of those things, right? Money is controlled by the central bank of each jurisdiction. And when I was at university, I kind of struggled to understand, well, why is that, right? Why can't we let money be a good that is determined by the free market? And so, given that was my perspective in 2010, 11-ish, when I came across the white paper, the original Bitcoin white paper, I think it was about 3 or 4 years after it launched, 2012, 13, that I was immediately drawn to it, right? This was a potential solution to denationalize money, which is not a new idea, right? Hayek was writing about it in like 1972, and he was drawing on influences from the 60s. So the whole premise of having a denationalized currency where different monies get to compete to be the best money was already in my head. So Bitcoin was naturally interesting to me. I was in a job that I didn't particularly enjoy at the time in management consulting. And therefore I was trying to do some other stuff. And one of the things I ended up doing in 2014 was I set up a sunglasses e-commerce business and ended up selling sunglasses for Bitcoin back then. And that was a fascinating journey, right? And, weirdly, it was kind of easier to buy and sell Bitcoin in 2013, 14, certainly than it was in 2019, 20. Now some of the solutions are making it much better. But at the time, it was so niche that lots of the frictions didn't exist. And so, as the ecosystem grew, as I came across Ethereum, which is a Turing complete version of Bitcoin, at least how I thought about it at the time, I just became fascinated, right? And the thing that's kept me in it is a strong belief that in the end, open ecosystems out innovate closed ones. I don't think it's even close. Free competition to make the best projects and to allow people to experiment with ideas is critically important. And crypto promises and web3 promises an open ecosystem for things like money and value transfer, certainly more open than what currently exists in the world. So, very excited to talk about it.
How much were the glasses? How many Bitcoins?
Yeah, I mean, so surprisingly, like quite a lot, right? Like
I'm trying to calculate, like how much is the worth now?
In today's price, what would a pair of sunglasses?
I don't want to think about it, Lawrence. In today's price, I basically shouldn't have done anything but keep those Bitcoin. I mean, I was selling sunglasses for anywhere between 65 and 200 quid. And at the price, we were talking maybe half a Bitcoin, third of a Bitcoin per pair.
So just 13,000 pounds a pair of.
Yeah, pretty cheap sunglasses actually.
Oh, that's a good deal. But okay, so you actually mentioned something that kind of inspired me, because I had this question back then in my head about free flow of money, free access, so all in the spirit of Web3. So we're all talking about decentralization and having this communities-driven governments, all of this stuff. But you guys are VCs, so similarly, with, let's say, the NFT space, when the art is now kind of bringing back to the community, tastemakers are taken away. This is all about, collectors' direct relationship with the artists, and then reduction of the gatekeepers. So looking at a lot of companies or projects, like even filmmaking now, they are raising money using DAOs, and getting direct exposure to the investors. Do you think that you are still a gatekeeper? And is that in the spirit of Web3 as a VC?
I have to jump in. I think there's definitely part of it, right? Like, I think there are two core angles here. One, which is access, which is being a gatekeeper. And I think that's like undoubtedly true, right? You have to get in front of, Lawrence, or someone in his team, or me, or someone in my team, in order to access the capital here. And that's something that, we're looking to try to reduce all the time. The second part of it, though, is, that we must believe that there's a genuine kind of selection criteria, right? And there's genuine sort of processes and skill in identifying the best projects. And in that regard, hopefully we'll be able to let the crowd do that at some point in the distant, not so distant future. But that's unproven. Right. So I think it'd be great to be able to erode the gatekeeping aspect and the access aspect while retaining the selection aspect, if possible, in some regard. Crowdfunding is kind of one way towards that. But I'd argue that there's lots of projects that you can see on there where that selection has really gone away. Right. If you go back to 2017, Q4 and Q1 of 2018, the selection of ICO projects was basically non-existent, and it got wiped away along with the gatekeeping. So I think the challenge is going to be how do you get rid of one while keeping the other?
I certainly agree with that. I mean, if I was to add anything, it would be circling around to the DAO structure, which you alluded to earlier. I mean, we've seen a lot of progress with DAOs. I mean, going back to the first Ethereum DAO 2016, which obviously notoriously got hacked. Since then we've seen significant progress, and DAOs are now, a much more commonly recognized structure, albeit less so from a regulatory perspective, more from a commercial perspective. I'd say their adoption, we've seen much more adoption and engagement within the NFT markets than, the wider Web3 funding market. I would say that governance towards DAO decision making is still, a key component, which is, in my mind, not quite there yet for DAOs to fully replace traditional VC structures. So I would say, kind of, until that period, or until that threshold is reached, that VCs, like us, will act, I suppose, as a gateway, but not one that's seeking to facilitate growth and drive adoption, as opposed to one that's seeking to inhibit it or stifle it. So, in some aspects, we are still seen as centralized gatekeepers, but ones which are, purporting, endorsing the growth of decentralization and, a greater adoption towards a decentralized economy.
Yeah, I mean, the dream, right, back in 2017, I remember like the dream / nightmare for funds is that like ICOs and token issuance would be able to totally replace early stage funding, right? Because if you think about the fundamentals of what a great founder needs, she'll need capital, she'll need talent, and she'll need access to customers and distribution. Well, an ICO will do all of those things, right? You're able to take capital in, you align incentives with a potential customer base, and you align incentives with potential like bunch of employees and advocates for the business. So at the time, there was a lot of chat about like, well, this model is just so much better than the VC and it can take over. I actually think there's still lots of truth in that, but the market needs to be ready, the infrastructure needs to be ready, and assessing the projects being a very key part of it, especially when there's such early stage projects with very little data. Like that's the hardest bit, I think.
I certainly agree. Just to add another point of interest on top of that, another perspective or component that made the ICO era so appealing to founders is the ability for them to raise without having to give away any equity. They were raising from retail markets, but as a means of capitalizing a business or of fundraising, it was truly innovative. Do certainly agree with you how it was ahead of its time. And with the right structure, and the right regulation, it could be, or I believe it will be, a very viable means for capitalizing businesses in the future. But if you look at the, if you look at the IPO structure, that was first introduced, I believe, early 60s. It wasn't really until the tech boom that, taking a company public via IPO became the norm, or the largest means of fundraising further to venture capital at that point. So I believe in the future that we will see a resurgence towards ICO style funding, although that will need to be done in a fully regulated and compliant manner, and perhaps more towards STOs, which was a hype or a kind of ideal which we were working towards in 2019, 2020. But I would say the regulation and the frameworks, legal frameworks globally, moving towards them. But we're still some time away from them. But if you look at how long it really took for IPOs as a means of fundraising to become mainstream, I would say you can kind of see ICOs, or you can see ICOs in respect to how early they are with how long it took IPOs to become mainstream.
I wonder if the more crashes we have, or like the ICO crash that Ziha mentioned, it kind of just calls for more curation / as you said, governance, and we're slowly kind of tailoring the system, so it kind of came with this decentralized, rhizomatic, complete free flow, community driven aspect, and yet we can see now like more and more companies are thinking about regulations, IPOing on the stock exchange like Coinbase, and actually like going through like a traditional financial institutions paperwork and all of this. And the same in the art world, like becoming more and more dependent on the curation actually process, rather than just advertising your artwork on Twitter. And I wanted to like now look back to the differences between fintech investing and web3 investing. So I mean, there is a trend that VCs, when they are entering the web3 space, we don't really see them going on board of these companies, whereas like in traditional fintech investing, you would be put on boards of these companies, and of course taking equity and stuff. How is it different for you, Ziha? Like when you can see like what's the difference between being a VC in the web3 space or a traditional fintech VC?
Yeah, I mean, for us at Octopus, not a huge amount of difference actually, because we invest in infrastructure plays, because we're not investing directly in protocols and investing in equity. They're very similar. I take a board seat on the companies that I mentioned earlier. I have a board seat on in the same way that I do for the more centralized fintech players that we invest in. I'd say probably the biggest thing that we have to like think about and consider is just like market risk is so much different and market timing risk is very different. So not only do you have to believe that the product is going to take off like you do with a normal business, you also have to believe the ecosystem will take off, right? And that just adds another layer of risk on top. And the other thing that you have to think about is the timing of that. So, typically, because these are early stage businesses which are not profitable, they always have a runway, which is how long they have until the money runs out. And one of the big differences, I think, certainly between the venture investing and public markets is that there's this common trope that you want to be contrarian but right. And if you're the only person who's right, as long as you're right, you will make lots of money. That doesn't really apply in venture capital, because if you're the only person that's right, it doesn't matter, the company will run out of money, right? You need someone else to come and do the next round and someone else to do the round after that. And I would say that with Web3 companies, that's just only accentuated, right? You have periods like this where the entire market will pull back, especially out of the most perceived risky assets. And therefore, thinking about that timing becomes more important. The only other thing I would say is that some of these businesses have an aspiration to launch tokens in the future, right? Because they're so close to that space that often it makes sense to build something that is native onto a protocol. The question there then becomes, given we hold equity, or potentially may hold tokens in the future, like where will the enterprise value of the business, or where will the protocol value accrue, right? Will it accrue into the equity which we hold, or will it accrue into the tokens? And then how does one think about liquidity if it's tokens? Venture capital in the equity space is a private market, a liquid asset. Once you start dealing with liquid assets, you can sell them whenever you want. That's a different investment sort of skill and a different approach to it, which one has to think about. And the other thing, I guess, something I never quite got my head around, Lawrence, you'll probably have a view on this. If the value is in the token, often if the early investors, or if the company themselves or the project founders themselves start to liquidate in any meaningful way, presumably that affects the price of the token because it's market signaling, as well as potentially not that much depth in the market. So how you think about realizing returns is probably quite different.
No, there's certainly some very valid points covered there. I'd say one other thing to factor in. I mean, it sounds, I see how like you have more experience kind of on both sides, and my experience has only ever been on the Web3 and the crypto, coming in from the crypto investment side. But from my perspective, at least, when it comes to a decision making within Web3 versus Web2, I would say that due to the markets being 24/7, much faster paced, I would say that you have to be able to react and assess projects pretty swiftly. Some of these investment rounds that we see, investing at pre-seed or seed stage valuations, sometimes are filled within a matter of days. Projects are extremely attractive. As a team, we have to be pretty nimble and able to, research fast, make a decision quickly. But, the structure of the investment is also different. It's more common for us to invest in protocols than equity. That being said, we have invested in some safe rounds, so, guarantees or guarantee for future equity with token warrants as well. However, it's less common as a Web3 VC for us to sit on the board than it would be in a traditional Web2 VC structure. That's not to say that I don't have direct channel of comms with every one of the founders that we support, and we'll speak to them on a weekly or even daily basis, and work with them throughout the life cycle of the project. But it's usually done, without the structure, of the traditional board, which I suppose has some benefits and some detractions. Speaking to the token emissions, or rather the unlock of founders, that's certainly something which we have to factor in strongly when we're looking at projects. Obviously, founders and teams usually holds, I mean, can be anywhere kind of between 15 to 25% of a protocol's total supply. So one thing which we're very cognizant of when assessing a project is the unlock period or the vest, which the founders and the team subject themselves to. You have to make sure that, as the token supply grows, as the supply is emitted, that there is demand or buy side pressure, to counteract the sell side pressure from the VCs, those who are in from private, from seed rounds, but then also, to suppress the sell side pressure from the founders and the team when they do begin to exit. So ideally, what we look for in projects is, long lockups for the founders and, vests that don't overlap with any of the private rounds. If a founder is looking to, have a full liquidity on their allotment within anywhere between 12 to 24 months, as a VC, that's, certainly a cause for concern, because, once the founder's moved on, then it, obviously raises tremendous questions as to, the future of the protocol, who's going to run the ship. So, that is something which we have to assess on a case-by-case basis. But I would say generally, the kind of the main difference is the speed at which we have to make these decisions, and also the, circling back to governance as well. We don't sit on the boards, but we do have direct influence over the founders, but not through a traditional board structure.
You guys mentioned a few times like timing, right? So you said like in the web3, it's of course faster in terms of decision-taking process, and also like the timing of raising funds that they could be slightly different. And it kind of leads me to the question about the market sentiment. So what's happening now, after the stablecoin crash? Do you see any changes? If any of our students, for example, have this great idea to start a blockchain company, a Web3 startup, how would they go, to raise funds right now?
I would say that there's always going to be demand for good projects, and good projects will rise irrespective of market conditions. If anything, the general market sentiment at the moment is bearish, both from a macroeconomic perspective as well as in the aftermath of the Terra Luna depegging, which has seen close to $800 million removed or withdrawn from the crypto market. But I would say overall, I've never been more optimistic about the industry in its long-term potential. The amount of infrastructure, the developments towards onboarding new users, towards regulation, towards comprehensive regulation, which is really, really needed for the industry and for the technology to grow and to thrive, has never been stronger. So, if there are students with fantastic ideas, I would say that there are always going to be VCs or investors who are willing to support them. But in the aftermath of an event such as the Terra Luna depegging, VCs just have to be more selective, and it's I would say it's a very refreshing cleanse for the market, because same thing as we saw towards the back end of 2017, 2018, as Ihao had alluded to earlier. Some of the fundraisers were ridiculous. I mean, founders could raise tens of millions of dollars with a white paper, and I mean, little else. We began to see that recently as well, certainly within the NFT market, which was too much froth, people FOMOing into investments without doing any diligence. I would say, the cleansing of the market, or kind of a retracement like this, forces you to go back to fundamentals and really assess projects. So it's out of market conditions like this that the real unicorns or the real innovative future protocols will emerge.
Totally agree. Nothing to add. That was wonderful.
But okay, so you have, so if it's a strong project, as you said, it can still get some funding. What are you looking at the founders or at the project? You know, if they want to send you a deck, what would be the thing that you look out most? Is there any difference between, again, fintech or not, or is it still kind of traditional, like features like the team, the strongest team, maybe a technical person? What are the key assets of a startup you're looking out for when you're thinking about investing?
Yeah, I'd say lots of the aspects are still very similar to traditional fintech. You know, having the right team in place, having the right product vision, having the right domain experience for the space within which you are building. The slight flavor is probably this. Crypto and Web3 has been really hot for quite a while now. And as a result, it's attracted lots of really smart people into the ecosystem who have seen how easy it can be to raise money. And sometimes they're attracted more by the ecosystem and by the valuation than they are by the underlying kind of fundamental use case of the technology and what it can bring to the world. And therefore, you can sometimes get really credible people who have lots of experience, building really cool stuff, who frankly don't need a blockchain to do what they're doing. And it's frustrating how frequently that comes up, because you have what I think of as just like wasted talent. You know, the number of people who've said, oh, we can do this like track and trace thing, we can do like whatever. Like, well, FedEx has had that for like 50 years, right? Like, why is it better than that? So I think that's probably one of the flavors I would add, which is, why is your product uniquely enabled by crypto, by Web3, by blockchain technology, right? Typically, it's because there is an adversarial relationship between the people on the network. Typically, it's because being open and having an ecosystem that can build on top of that network is critical for its function. It can be the fact that you want value transfer in a way that other people can build onto, can fork, whatever it might be. There has to be some reason why you would trade off having like a much faster database in a centralized location versus being decentralized.
I would agree with most of what Zihao said there with regards to assessing founders. What we're looking for is founders, passionate founders who have a very strong understanding of the product market fit and the opportunity that they're addressing. And the strength of the team. Often in projects, the teams have to be able to sometimes pivot, and it's not uncommon within Web3 projects for protocols, DeFi protocols, to look to add different functionality, whether it be a yield optimizer that's looking to aggregate funds from a layer 2 within the ecosystem. But the ability for teams to solve problems and have a very comprehensive understanding of the technology, the programming language that that ecosystem exists within. All these signals, I would say, are pretty similar across Web 2 and Web 3. It's you look to invest in the team more so than the project. Obviously the team has to be able to execute on the project, and you look for the opportunity, the addressable market within the project. But if I don't believe the team won't be able to execute on that, that will be an immediate strikeout from us.
I'm just trying to find, but I cannot find. I think Arthur Brightman did post on Twitter that the guy from Terra, he is a professor of economics in Harvard or something. The team looks pretty good. So what went wrong?
Well, here's the thing, right? So what's a signal of a good team? I think people often conflate like nice looking CV with great team. There are lots of smart people out there who can do lots of like really clever jobs, but the DNA required to be a founder is pretty unique, and it combines lots of different aspects. And you may have somebody who doesn't have a good CV at all, who could be a fantastic founder. You may have someone who's collected degrees from Harvard, Stanford, Oxbridge, did stints at Goldman Sachs and McKinsey and whatnot, and still be a terrible founder, right? And actually, if I may, that's almost the entire point of Web3, where you don't need to be credentialized anymore, right? Anyone is able to build because it's an open ecosystem. And therefore, if you build something cool that people want to use, that is useful to the market, that generates value while taking up less value than it generates, it doesn't matter who you are. You could even be anonymous. Now that creates lots of problems, clearly. But one of my favorite examples, or I guess analogies, is with gaming, right? In the gaming sort of ecosystem community, anyone can win a tournament as long as you're good. No one is saying you have to sign up to this academy, to this coaching sort of thing. Your CV has to be this. You have played this many years of experience. No one cares. As long as you're good, you can win. And often you get winners from places that you would never expect. Right? That doesn't exist yet today in business. Right? People look at your CV. People look at where you've been, what you've done. But we ought to have a world where that doesn't matter so much, because those signals are okay. They're not brilliant.
I certainly agree with that. One thing that brings to light a project which we've recently invested in, actually, Sonar Protocol, which is aiming to give users a cognitive fingerprint, essentially assessing their intellect. So it looks at different aspects of intellect, short-term memory retention, cognitive processing, but it's looking to address the market of users who either can't afford to go through traditional university, college educational systems, or they haven't had the opportunity, but are inherently incredibly intelligent. So that's a project which we recently backed, which will be coming to market within later this year. But they're looking to mint users' cognitive digital footprint as an NFT, which can then be verified by employers, by educational institutions, and can be essentially a digitally verifiable record of an individual's cognitive or mental aptitude. So just interesting kind of follow on from Zihau's point. But within this industry, there aren't the same barriers to entry that exist within traditional finance and Web2. If you're if you're smart and if you're building something exciting, you have the whole Web3 as an addressable market.
I mean, think about Vitalik, right? Can you imagine a committee getting together and saying, the world's largest distributed computer, who should we get to build it and run it? This 19-year-old.
Yeah.
No one would ever say that. But the fact that he just went and did it with the team, that's what matters here, right? It's not about selection and credentializing and sort of signaling. It's hopefully more and more about just action and value.
Right. So on action and value, what are the most exciting future use cases of blockchain that you kind of are looking forward to?
I mean, I'd say most of the use cases have been identified. I'd say the applications, or the applications of them are yet to materialize. A few of the ones which I'm pretty excited about, I suppose, real identity management. So passports, insurance, which is an area which I'm working quite closely within. NFT technology. I mean, people today think about NFTs as pixelated JPEGs by the majority of the masses, and you'll hear stories about CryptoPunks, Bored Ape Yacht Clubs being stolen. But the actual underlying technology there is in its very primitive stages, but holds huge potential in the future. When an NFT could represent the title for ownership of your house, the friction that will reduce and the liquidity that will create in the future towards trade is phenomenal. So yeah, NFTs, insurance, the Internet of Things is another one which would be pretty exciting. Again, 5-10 years in the future. I mean, we've seen some blockchains building towards that, IOHK, but smart cities, the actual, the remaining piece of the puzzle is yet to catch up. So I'd say, the applications have been identified, or the use cases have been identified, but many of the applications are still yet to be really materialized and for their benefits to really be widely recognized and adopted.
Yeah, I find this question really difficult to answer. And the reason for that is, to me, Web3 ecosystem allows an open ecosystem for building on value, right? And what's valuable about that is that people, anyone like a Vitalik can just build and experiment. And we don't know what the best ideas are going to be. And therefore, if you have an open ecosystem, anyone gets to experiment and hopefully the best ideas win. If we knew what the best ideas were going to be now, we wouldn't need an open system, right? We would just go and do those things. So to me, it's the kind of crucible, or it's the entire ecosystem that allows people to experiment that's valuable. And what comes out of that will be really interesting, right? And I think Lawrence is totally right. It will be across identity, across assets, across finance. One that I'm particularly excited by in the future. I don't know how close we are to this, but it's this concept that I didn't come up with this. I wish I did. This concept that you can basically put science on chain, right? So right now, the way science is done, you have lots of people who write papers, submit them to journals, they conduct experiments. Hopefully they're replicable, most of them. Not all of them are, lots of them aren't. But you have people that submit papers to journals then publish them, they get cited in the next paper, and you kind of build on knowledge that way. The trouble is, there are lots of papers where you can go back and see that, firstly, one of the underlying tenets that you've cited is not replicable, so that doesn't work. And secondly, how do you incentivize people and reward people properly for creating science that then creates value, right? So the idea of being able to put like a Merkle tree of citations, sorry, actually, you mentioned that the audience is not that into crypto. The idea that you can put like a link between every single bit of science that's ever come out, ideally all the way back to like Maxwell's equations, or like Newton's Principia, and you're able to build, on the fundamental things that we know about. And every time a piece of science is updated or refuted, we know exactly, what implications that has for everything else that's been discovered. Like, to me, that is massively exciting, right? I think that the way that we discover new knowledge as a species could fundamentally change, and the implications for productivity, for improvements in living standards, are overwhelming. Now, the implications for like our ability to kill ourselves is probably also higher, and we need to manage that properly. I think that there's a long way to go before we get there.
I am very excited about the idea you just said. I think we had this workshop with actually School of Management, the UCL Dean and some other chairs of Academy of Management Journal. And there was this big discussion about like, actually, especially management academia, it's not getting as much impact as we would like to. So, you write all of these papers, but no one is really citing you, or even if they citing you, they would mention your theory, but they would not even cite you, because it's very unsexy apparently in business to say, oh, this concept, this framework, I took it from a paper. So they'll be like, oh, this is kind of like this methodology that, is quite popular right now, but none of the researchers, none of the authors of the paper are being cited ever in PowerPoint slides. And you don't see like underneath, like this is this paper here. And it kind of like shows like how little, it feels like the impact of management academia has comparing to economics, because these guys are kind of more theory oriented, and it all kind of like stays in the same ecosystem, whereas like, in terms of business or management, once it goes out to the real world to practice, it's kind of like out of our hands. So that's very exciting if you can like somehow at least track that on chain. The only concern is that, sometimes it turned out to be that the experiment was done badly, and we just would like to withdraw that from the chain. It's like, there's a lot of like research that is.
But you ought to be able to do that, right? And actually, if you're able to track independent replications and put that on chain as well, like, wouldn't that be wonderful, right? I mean, I heard this great quote, like, the only difference between good science and bad science is the number of independent replications, right? And if you're able to track every single one of those and put that on chain, like, we can reinforce the good science and discredit bad science, which would be great.
Yeah. One of the use cases that I really like is POAP, proof of attendance protocol. And the application that hasn't been yet done that I'm quite excited about is education, actually. So right now we're using POAPs for events. So you would go to an event, and I'm actually going to share a POAP for today's session. So a lot of panels that I'm doing, I do share that POAP. So people can I do it? People can scan it and get it on their wallet, kind of a free NFT, just showing that you attended the panel. And why I'm obsessed with it in terms of education is that, when we're teaching, we're having this physical A4 sheet papers, people are writing their names that they attended the class, and actually they're writing like 5 other friends that actually are at home. And I don't like, when a class is big, I can't really like calculate everyone and like really check like who actually is in the class or not. Whereas like with this POAP, like the QR code is uniquely being generated just within like a window that is preconditioned. So, only you with your device can scan it. And I think that, if we have more and more online classes like this, it would just be very easy for me to see who attended the class, and then maybe based on, the number of maybe workshops that you attended, you get a certificate from an educational institution. So just a simple weird application that I think could
that
solve.
Scares me a lot, by the way, because like that would have shown that I never went to any of my lectures and probably wouldn't have graduated.
Yeah, but I mean, I'm from like the other side, so in terms of just having sometimes absence, but it doesn't have to be rewarding your grading, but it's just for you to also show later to your employee that you actually went to this, the old school tradition, like, I went to the McKinsey workshop. Yeah, there you go, there's a POAP. So I think like that could be quite interesting and a fun way to introduce NFTs to the educational system. I show POAPs usually at the Q&A sessions, and we have 9 minutes left. So I will pop to like one question actually, or two that I see on YouTube. So the first one is it essential for the Web3 startup to be backed by some well-known institution such as Imperial College to raise funding?
I would say certainly not. I mean, that's one of the most exhilarating things about this market. You can go out to, founders could literally set up an account and, take their project out on Twitter. And, if the project's strong, if what they're building is interesting, I'm very, very confident that founders would be able to secure the funding they needed through unconventional means, such as social media, without the endorsement of a world-renowned educational institution behind it. There are some projects that do secure whether it's an endorsement not from an educational facility but from a top-tier VC. Those projects do tend to be more sought after, harder to access from some of the smaller VCs. But as a founder simply looking to fundraise, I would say no, it's not a prerequisite for you to have a stamp of endorsement from Imperial, for example. You can simply, it being Web3, just go out to the market and appeal directly to the market. But if the university is willing to put its stamp of endorsement or some of the resources behind it, or behind you to help you bring your product to market, that will certainly only contribute and be a signifier or a stamp of endorsement towards the wider market.
Yeah, totally good, Lawrence. I'd also say, like, to maybe go even one step further, right? Be careful which institution is endorsing you. Some of them, like the example I go to is, it's kind of like going to a party and then having your mom tell everyone that you're really cool, right? Like, you know, you've got to be a bit careful which institution and what their kind of credentials are within the space and how much they truly understand Web3, because some may, hinder rather than help.
Mm-hmm.
Also, fantastic analogy too.
Never happened to me, of course.
Yeah, we both, like, all of us actually, we're just saying like, oh, it doesn't matter institutions, but actually, like, throughout our careers, like, it did help quite a bit, like just some old school labels. And then the question here, I think I will adapt it slightly because I think it's more to like a founder, but you guys are investors. So how hard was it for you to raise funding when you first started? I can twist it into how hard was it for you to raise, to raise for your fund when you first started, how did you convince investors / LPs to invest in the future technologies like Web3?
So at the moment, we are managing proprietary capital. So myself and the partners are the LPs in our fund. We will be fundraising come September. However, our first fund is essentially closed proprietary capital. So I can't speak too much on that one. We have declined a bunch of capital interest over the last few months, because the position that we're in and the access to the industry that we have is very sought after, which is why we, decided to open up to external capital and onboard external LPs. However, the fundraising is never easy. As a founder and as an investor who's spoken to multiple founders on their fundraising journey, it can be really, really challenging. I do, encourage you to always persevere. One of the founders I've worked very closely with over the last few years was closing out his seed rounds just as COVID really kicked off. And, a round which was anticipated to be closed within a few months ended up dragging on much longer, north of 12 months. But, he kept his head down and persevered, and the company is now looking in fantastic positioning. So, I would say if you are a founder looking to embark on that journey, don't be discouraged. Every door that is closed on you, there's a million more that you can walk through. And there will always be opportunities out there as long as you're diligent and vigilant. So yeah, that's all I have to say on that one, at least.
Yeah, I think in addition to Lawrence, so from a fund perspective, I was very, very lucky to join a fund that was already raised, and we have a fantastic network of advisors within that work with Octopus to help us fundraise every year. So it's quite a different challenge, I suppose, to perhaps a more traditional GPLP structure. I think in terms of advice for founders who are fundraising, totally agree with Lawrence. It's there are so many sources of capital, and lots of people will not understand your idea well enough to fund it. The only thing I would add is if and when people are saying no, try to really honestly assess whether they're not investing because they have some assumptions they have made about your business that are untrue, assumptions that may be based on experiences that reflect a world that no longer exists, or assumptions based on like market heuristics, things that people say, but not based on fundamental analysis of what's actually happening in the market, versus when people are saying no because of a real kind of reflection of the underlying market, right? That's one of the hardest things to do as a founder, because if you're right, probably 98 people will say no and 2 people will say yes. And if you're wrong, probably 98% people will say no and 2 people say yes. So trying to discern like the reasons people agree with you or the reasons people disagree with you, and sort of having a really honest like sort of assessment of whether the reason is a valid one or not, can be one of the most powerful things for a founder, because you're able to learn and iterate from other people, which is, clearly a lot quicker and more efficient than trying to make all the mistakes yourself.
Amazing. I think this last tip was super useful actually for any of student teams who are planning to raise in the future, not even in the blockchain space. So I think we're kind of going close to 6 p.m. So I just would like to thank both of you so much for coming and speaking today with us. And I mean, a lot of useful tips. I think we all can learn from that. Very useful for both. Yeah, even someone who is not trying to raise a company in Web3, but even just to get involved in, and I think just having this understanding of the space from your point of view was very kind of insightful for us. So thank you so much.
Pleasure, Mimi. Thank you for having us, and thank you for Near and for Imperial and Manor all for hosting.
Yeah, thanks, Near.
Thanks so much.
Thank you. Have a good evening.
You too. Bye-bye.
Yes.
Bye.